Welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services for us in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown. Hello, Michael. It's been a couple of weeks, but it's certainly been an interesting couple of weeks.
It has, yes. Very good morning to you, mate. It's been, as you say, an interesting, choppy, and volatile couple of weeks that we've all had to deal with while you've been off enjoying yourself on another well-deserved holiday.
Yeah, I mean, you should take more time off, Mike. Or you work very hard. Once we've got the mutual backslapping out of the way, we've got quite a bit to talk about, because in addition to company earnings, stock markets have continued to rally after the announcement of the 90-day suspension of the punitive tariff regimes between the US and China to levels of 30 and 10%. It does beg the question, is the tariff war over, or is it just merely deferred? There's a good article on the Good Money Guide website by Jackson Wong about that, where he has highlighted the key beneficiaries of the suspension of the tariff war. So it's certainly well worth you having a gander and having a look over that particular article, and we'll touch upon some of the key companies that's benefited. We're also going to look at central bank rate decisions, the Fed decision, the Bank of England one, which was, I think, fairly contentious, I think. Yes, we must, Michael. And look at this week's GDP numbers. Are they as good as they look? Spoiler alert, they're not. And also, we'll look at the results from Next, IAG, JD Weatherspoon, Apple, Amazon, Disney, as well as looking at this week's numbers from Burberry and ITV before looking ahead to next week's CPI numbers from the UK and numbers from Vodafone, BT, EasyJet and Marks and Spencer's. But before we get any further, and I've been talking a lot, and before you remind me, as I know you will.
Or I get told off by compliance.
Indeed, it's risk warning time. So without further ado, here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex financial instruments and come with a high degree of risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So, the UK and the US have signed off a modest trade deal. I hesitate to use trade deal, but it does cushion the UK to a certain extent from a lot of the tariff fallout, albeit tariffs on UK exports to the US still remain higher than they were at the start of the year. And Joseph Stiglitz has gone on record as saying the deal isn't worth the paper it is written on. So, Michael, thoughts?
Well, he is absolutely spot on. I mean, everyone is sort of touting this as a trade deal. In fact, I would maybe go even further than him and say that actually that it's not even written on any bit of paper, because the press releases that they issued said that the details will be finalised and written up in the coming weeks. So it's all well and good saying we've got a deal, but no one actually knows what the hell is in this deal, who's given ground on what, who's committed to what. This is all still very, very unknown. I think the biggest sort of takeaway from all of this for me was that the United Kingdom and the United States, trade is pretty much equal in goods on both sides. The US is not running a trade deficit with the United Kingdom. And also you have Donald Trump as president, who has said on numerous occasions that the special relationship is very important, that the UK is a great friend and ally of the United States. Yet despite those two things, as you rightly said, the UK is still subject to this 10% baseline tariff. Now, of course, what I would say in reaction to that is we are supposedly friends with the United States and we have a 10% tariff on our goods that we send to the United States. How on earth do we think that the United States is going to treat what it perceives to be less friendly nations, whether that be China, whether that be Vietnam, or nations that or trading blocs that Trump seems to have a sort of outright hatred of, like the European Union? You'd imagine they're going to get a much, much worse deal than we've ended up with.
So maybe Brexit has its benefits after all then.
Well, perhaps. Has anyone told the Financial Times yet?
No, I think that's going to be contentious to perhaps some of our listeners, but ultimately, politics aside, what's done is done. Okay, well, I mean, a lot of skepticism, obviously, around the deal. Markets don't appear to agree, though. We've got the DAX posting new record highs since we last spoke. The FTSE 100 back above its 200-day moving average and back close to 8,700. We've got US markets, the Nasdaq and the S&P back above their 200-day moving averages. So ultimately, everything looks hunky-dory again, and it's almost as if the last couple of months hasn't even happened.
Yeah, you're absolutely right. I mean, I must admit, I think it was earlier this week when we had the news out of the US-China trade talks in Geneva that they've announced these big tariff rollbacks for the next 90 days, which I'm sure we'll discuss in more detail in a second. I did sort of sit and wonder to myself, what the hell was the point of the last 6 weeks? Because we've had all of this volatility in financial markets, all of this capital being wiped out to basically end up with a trade position back exactly where we were in the sort of middle of March. I think the key sort of takeaway for me from a market perspective, particularly in terms of equities, is we seem to have now moved past the point of peak trade uncertainty, past the point of peak noise on the tariff front. And I think that the belief among market participants now is that, to quote the song, things can only get better. There are deals being done. There is a truce that is in place between the US and China. It does seem, at the very least for the time being, that we are on a journey to things becoming more conciliatory in nature and the rhetoric becoming a lot softer than we were, if you'd asked me this time a month ago.
Yeah, I'm perhaps thinking that President Trump has become very painfully aware of the realities of pushing the markets too far. And ultimately, that more than anything has made him soften his tone, and perhaps wiser counsel from people like Mr. Besant.
Yeah, very possibly. And of course, actually, one of the interesting things that we have seen is that, well, obviously yesterday was slightly different. We saw bonds rally across the curve, while stocks have retraced pretty much all of the losses that we saw during the month of April. Treasuries have continued to sell off, and actually the 30-year touching that psychologically important 5% level again yesterday. So I think you might be onto something there. I think that some of the volatility that we saw, and certainly the sell-off across the Treasury curve, giving the Trump administration a little bit of a wake-up call and saying, you haven't got a free pass to do whatever you want. And there are some checks and balances. Whether they come from Congress or whether they come from investors is another matter.
Yeah, which sort of neatly brings us on to obviously those two central bank decisions from the Federal Reserve, which was pretty much as expected. I think Powell handled that pretty well. He didn't step on any landmines, although obviously Trump has renewed his calls for Powell to cut rates, completely overlooking the fact that Powell is just one voice amongst many on the FOMC, and he alone can't set monetary policy. Moving past that, Bank of England, I think that was a very strange decision. Yes, we got what we expected, 25 basis points, but we got two people calling for 50. No surprises that Swati Dhingra called for a 50 basis point cut. What I think surprised me most was Catherine Mann. Now, she called for a 50 basis point cut in February.
Yeah.
I think it was February, or was it? I
can't
remember.
February,
I think
yes, it was.
It was February. And now she's argued for the status quo, as well as suggesting that the labour market is fairly resilient. Well, unemployment's at its highest level since 2021 at 4.5%. And all regional surveys from the Bank of England suggest that the labour market is softening. So what's going on there? Because ultimately, even though they cut rates, yields are higher.
Please don't ask me what's going on. I have not got a clue what is going on. You and I know we like to moan about the BOE, but I think we are justified on this occasion. And as you say, it was a very odd decision because you got the 25 basis point cut we expected. And the bank gave us their latest economic forecast, which in summary said the economy is going to grow slower than we previously thought. Unemployment is going to be higher than we previously thought. And inflation is going to get back to 2% quicker than we previously thought, 9 months quicker. So it's not a small revision. Yet you end up with a policy statement that is basically unrevised and a very, very hawkish growth split, a vote split, forgive me. And then you get all of these NPC members coming out in the days and weeks following the decision. As you say, Catherine Mann saying the labour market resilient. Well, I'm sorry, we've lost at least 30,000 payrolled employees in 5 of the last 6 months. Where on earth is the resilience in that data? The BOE may say, oh, well, wage growth is incompatible with 2%. Yeah, but the rate we're going, that's going to be wage growth among about 3 employees because there's going to be no one left if the jobs market continues shedding employees at the rate it is. I honestly do not know what is going through the minds of policymakers at this point. And I can't help but thinking that we're going to end up in a situation where June is off the cards. for a rate cut. So we're really now talking about August as the next live meeting from the MPC. And I think it just feels inevitable now that we end up in a situation where the MPC find themselves massively behind the curve at the back end of the summer.
Yeah, I mean, but having said that, I've been one of the most vocal critics of the Bank of England for the last 15 so years since the financial crisis. But one thing I will say about this particular policy committee is that there is no groupthink going on.
No, you definitely can't level those accusations.
No. So there are discussions. And ultimately, I will never criticize central bankers for robust discussions about the state of the economy, where the economy is, because ultimately, given all that we know, no one's got a clue. No one's got a Scooby-Doo. So ultimately, what you're doing is you're making policy on best case scenarios. So while you can criticize the outcome of the decision, I don't think you can criticize the process, because the process over the last 15 years has got us to where we are now. There's been too much groupthink and not enough thinking outside of the box. Now, with all the policy uncertainty that we've got at the moment, ultimately, while you can criticize the outcome, I don't think you can criticize the process in the way that you could under Carney.
Yeah, no, I think you are right on that front. The other thing I would say is that, and something that has been slightly overlooked because we've all been focusing on the growth split and all the rest of it, but vote split. I've made that mistake twice now. If you go into the minutes of the MPC meeting, you'll actually find that for many, which is MPC speak for 3 usually, of the members who voted for a 25 basis point cut, and remember there are only 5 of them, for many of those it was actually still a close call between whether they go for a 20 basis point cut or whether they hold bank rates steady. So I think we were actually very close to a situation where, probably closer than most participants would realise, we were actually quite close to a situation where the bank actually kept a bank rate on hold last Thursday, which would have come as a real surprise. But yeah, I really don't understand how the bank is reading the economy at the moment. I'm struggling massively to get my head around their take on things.
Yeah. So we did have some good news this week. The UK economy grew by 0.7%.
Let me just get the bucket of salt that I've prepared to take with this data.
Well, the thing is, I'm sort of teeing you up, mate. The UK economy, good news this week. Latest data from the Office of National Statistics, bellwether of fine data, he says ironically.
The ones who make China look accurate.
Yeah. Showing the economy grew by 0.7% in Q1, better than forecast, and by 0.2% in March. So, according to the government, everything's hunky-dory. We all know that's complete. I was going to say something a little bit ruder.
You had to stop.
But I'm just going to say nonsense. Their services grew. Biggest contributor, 0.7%. Consumer-facing services saw an increase. We know that the consumers held up fairly well because of the retail sales numbers, but also a lot of the updates from various retailers. From the likes of Sainsbury's, Tesco's, even Next posted a fairly resilient set of numbers earlier. Why aren't they as good as? I know the answer to this, but I'm going to throw it to you. Why are the numbers flattering to deceive?
Well, I think there's 2 big reasons why, and actually, one of the things we've spoken about a lot on this podcast and pretty much every markets podcast is uncertainty. But actually, in the first quarter, there were 2 things that were certain. The first is actually 3 things. Forgive me. The first is that national insurance contributions for employers were going to go up in April. The second is that the minimum wage was going to go up in April. And the third was that the US were going to impose tariffs on the exports that we send them in April. As a result of that, you've got businesses across the land going, well, we're going to try and front load and pull forward as much activity as we possibly can before those 3 factors begin to adversely impact us. And if you look into the data, the services number was probably boosted by those first 2 factors that I mentioned. And then the front running of tariffs comes through clearly in the export figures. Exports to the States were up 16% quarter on quarter, which I think was the biggest quarterly rise since the middle of 2022, which is basically importers in the States going, get your goods to us before we have to pay a tariff that may be levied on them. So yeah, fine. The economy did grow by a much faster rate than expected in Q1. And yes, Rachel Reeves is right. It was the fastest growing economy in the G7. The problem is that's been skewed by a whole host of one-off factors. And frankly, I think it's probably as good as it's going to get for the UK economy this year. You look at things like The PMI surveys in April, they fell to the composite gauge was at a 2.5 year low, back below 50, well into contractionary territory. All of the other sentiment surveys have pretty much fallen off a cliff as well. And we get the latest read on PMIs next week, which we may touch on later. So I think, given the degree of downside risk, yeah, great, but GDP was good, but don't be popping any bottles of champagne just yet.
Well, that exports number also bears out the US GDP numbers for the first quarter as well, because the economy contracted there because of a surge of imports.
Exactly.
So they sort of confirm each other. So you would like to think that situation will reverse in Q2, which means that Q2 could be a hell of a lot more challenging for the Chancellor.
Well,
so
I think there's a real risk of a quarterly contraction in the second quarter, to be honest.
Well, that's interesting because the government's been quick to claim credit for a decent set of numbers for Q1.
It'll be someone else's.
Hopefully they'll be as quick out of the traps in 3 to 6 months' time when the economy nosedives off a cliff.
Yeah,
but somehow I doubt it.
I think it was 10 minutes before the data was released yesterday morning that I actually put out on Twitter something along the lines of, I'll give it half an hour and Rachel Reeves will be out claiming credit. And as if on cue, there she was, because, saying the plan for growth is working, but never let a good crisis go to waste, as they say.
Indeed. And interesting, actually, that in the next PLC's trading update, they said that an awful lot of spending was brought forward from Q2 because of the warmer weather in Q1. And consequently, that's why that influenced their guidance when they reported, and we'll touch upon that later. But it certainly bears out the fact that the warmer weather also helped in regards to the decent numbers in Q1.
Yeah. No, I think you're absolutely right. And again, that's something that we'll, as you say, touch on later. But also we get the latest retail sales figures next week as well. So we'll see how that impacts those.
Well, we had three strong months, January, February, March for retail sales that you would have expected a fairly decent set of GDP numbers. Anyway, let's move on. I think we've probably done that to death. Let's look at the numbers that have come out since we last spoke. Now, obviously, we last spoke 2 weeks ago, just over 2 weeks ago, and Apple and Amazon followed on from Microsoft and Google with some fairly decent sets of numbers. Apple in particular. The share price response to Apple's results has been a bit meh, actually. Record revenue of $95.4 billion for that particular quarter in Q2, an increase of 5%, and profits of $1.85, an increase of 8% on the previous year. iPhone revenue, 46.8 billion, Mac revenue, 7.9, iPad, 6.4. Services continues to grow as a share of income, which probably is a good thing for Apple, given the fact that iPhones are probably going to struggle in the face of Mr. Trump, even if they do shift production to India, because Trump's come out and said to Tim Apple, as he likes to call him, that he's not a big fan of him moving iPhone production out of China to India. But ultimately, if he wants it in the US, they're going to have to pay a hell of a lot more for them, and it's not as easy as just shifting a supply chain in the space of a year.
I think that's probably one of, if not the main reason why we have seen this sort of tepid reaction in Apple shares. And actually, I'm just looking here at, if we can still use the term Magnificent Seven, because they haven't been that magnificent recently, Apple is actually the worst performer of the bunch year to date now, just marginally underperforming Tesla. But I think you're absolutely right. The sort of plan A for them to avoid tariffs was to basically ship everything in from India instead. As you say, Trump has yesterday said that he's not overly keen on that idea. You're sort of left scratching your head going, well, do you raise prices? Do you bring everything back to the US? Do you absorb the cost of the tariff? How do they play that scenario? But I think it's also something that's worth considering, just to go off on a little bit of a tangent, for all the other companies that have got big manufacturing bases in Asia. This idea of transshipment, or moving things around various other factories to try and get around tariffs on China. It appears that the United States administration are going to take a very, very dim view of that, which, as you said, leaves the choice between paying a chunky tariff and increasing your prices quite significantly, or building in the United States and increasing your prices quite significantly because your production costs go up. So it's certainly going to be one to watch, that.
Yeah, I suppose Tim Cook could say to Donald Trump, well, I can bring it back to the US if you want to pay $3,000 for an iPhone as opposed to $1,500.
Yeah, exactly.
But then do they have the skill set in the US?
Well,
I'm not sure they do.
And not only the skill set, does the US worker, to coin a general term, actually want to go and screw iPhones together all day? I would argue they probably don't. So it's all well and good sitting here going, yes, everything will be reshored, we can build in the United States, but that looks very good and easy on paper. It's very, very difficult to actually put that into practice.
Yeah, it'll be interesting to see how Apple handles that and whether it affects future profitability, in the manner that it is, because their margins are still fairly decent, 46% on a gross margin.
Yeah.
It's still pretty good.
Yeah, I mean, you certainly can't complain about that, but I think that's where, as you said, you're really looking for something like the services revenue to actually
Yeah.
potentially pick up some of that slack that you may see in other revenue lines because of all of the trade difficulties that are going on.
Well, I mean, Tim Cook said that tariffs are likely to increase costs for Apple by about $900 million in the current quarter.
Yeah.
I would imagine that number will probably go higher in subsequent quarters. We'll have to wait and see. I mean, nearly $1 billion. That's a hell
Yeah.
of a lot.
And even for a company like Apple, that is a hell of a lot.
Okay, Amazon Web Services, again, cloud revenue there, fairly decent. Also, on the retail side, revenues fairly solid, $55.7 billion across the business, up from 143.3 billion a year ago, and a 70% increase in profits on Q1 last year. So again, Amazon seems to be doing very well. They did upset Trump on reports that they plan to show shoppers how much extra tariffs were adding to prices.
Oh yeah, I'd forgotten about this.
It was a report that was swiftly denied, but ultimately I think, what's the harm in that? I think on a personal level, I think that's a brilliant idea, especially here in the UK, because it could be applied to taxes on fuel and energy products, where it showcase how much taxes and levies from the government have added to the cost of living crisis. I mean, the fuel duty escalator on petrol prices is around about 57p of the pump price, which is around about £1.34. On top of that, you've got VAT at 20%. So, it gives you an idea of how much the government is taking in taxes and is actually adding to the cost of living crisis. And I'm pretty sure the same applies to fuel bills as well.
No, I think you're absolutely right. I mean, I've got to be honest, I'm not entirely surprised that Amazon pulled a rather rapid U-turn on that one, given the wrath of the Trump administration that they felt quite quickly. But you're absolutely right. I mean, what is the harm in it? Ultimately, that we know that the reason prices are going to be increasing is primarily a result of tariffs. And if anything, that may actually work somewhat in the consumer's favor, because I know there was some chatter around, is this just going to be used as an excuse by companies to widen margins, to a little bit of price gouging going on. Well, actually, if you strip out the cost of a tariff and throw that explicitly on your website, you can see whether there is any cheekiness going on the corporate part, or whether they are merely just passing on the increased cost of that levy. But clearly the politics has outweighed the logic on that one.
Yeah, indeed. Well, you can't have the plebs knowing how much they're being ripped off by the government for taxes, can you?
No, of course not. Of course not.
And by using the term plebs, I'm meaning me as well, and
yeah,
you.
I was going to say, we're definitely included in that. Don't you worry. But yeah, again, I mean, the slate of results themselves, setting aside the issues in terms of tariffs, were pretty good. I mean, the guidance was maybe touch soft, but again, how can Amazon really give concrete guidance, only concrete optimistic guidance in this sort of an environment when particularly Amazon, more so than most of their peers, are massively exposed to changes in trade levies and also this de minimis tariff exemption, which has now been entirely shelved. I wonder how significantly that's going to hit them.
Yeah, indeed. And you touched upon that. That's why guidance was a little light, and perhaps explains some of the lackluster performance since then. But ultimately, I think they're still not too far away from their record highs. Anyway, moving on. Last week, Next PLC delivered again on profit guidance, another upgrade. Although it didn't touch its net sales figure. It left that unchanged. An 11.4% increase in full price sales, £55 million ahead of forecasts. And this is where the warmer spring weather comes into the equation. They believed, due to this perceived pull forward, Q2 sales guidance was kept unchanged at 6.5%. Profits guidance up to £1.08 billion, an increase of £14 million. Next is one of the best performers this year on the FTSE 100 in the top 10. At number 10, I think.
I can tell you, because I've got it in front of me here, they are indeed at number 10, up 33% this year, which is not too shabby.
Along with Babcock's, BAE Systems, Rolls-Royce, and
You're
Lloyds
just
Bank.
proving your photographic memory now, aren't you, mate, from the email I sent you about 10 minutes ago?
I knew they were in there somewhere. I think there's Airtel Africa in there as well, and a couple of
Yeah,
others.
all right, you're just showing off now.
I am indeed guilty as charged. But next share price is at new record highs. I mean, we talked about it 2 weeks ago. I said it was at record highs then. Can it go any higher? Is the good news all priced in? It's carried on going.
Yeah, absolutely. And the other thing we spoke about a couple of weeks ago was the guidance upgrade, which they tend to always deliver. And I remember we were saying, is this going to be the time when they actually don't deliver? Well, no, it wasn't. So the wait for them to not upgrade their guidance, that does go on. But as you say, that comment on the consumer more broadly in terms of the second quarter was interesting. If we have seen a significant amount of spending pulled forward, could that be potentially just a sort of modest near-term headwind? But as you alluded to, they don't seem to think that's going to bother them too significantly in terms of the financial year. So maybe it's not worth worrying about that much.
Certainly not in terms of profit, perhaps in terms of full price sales. They are predicting a little bit of a slowdown there, even if they haven't changed their full year figures. We also got a decent set of numbers from British Airways, IAG. Revenues rose 9.6%.
I was expecting they've taken off, or they've landed the plane smoothly, or encountered some turbulence or something.
No, they haven't encountered any turbulence. Essentially, they've basically
they're at cruising
moved a little bit higher in terms of altitude when it comes to the share price. Still not back at the levels they were back in February.
I don't know why I'm egging you on now. I'm regretting that massively.
But we talked about the fact that people were sort of eschewing the United States as a destination. There was talk about that in the mainstream media, that people were saying, well, we're not going to the States because of Donald Trump. And I sort of called out that nonsense for what it was. Well, certainly in terms of British Airways and IAG, there doesn't appear to be any significant side effect from that. Operating margins are up 2.8%. Operating profits are up 198 million euros, well above expectations of 133 million euros. And actually, they're ordering 53 new aircraft. About bloody time, because a lot of their fleet is pretty tired. Having said that, I mean, the last time I flew on a BA aircraft was a few years ago. But certainly, I think one of the key criticisms I've always levied at it is that the fitting and the trim of their planes has always been below the likes of the Dubai carriers or the Middle Eastern carriers like Emirates and Qatar. And ultimately, that's the benchmark I think that you need to set if you want people to get on your aircraft.
Yeah, no, I would fully agree with that. Yeah, you're absolutely right. I think the issue with British Airways from a customer point of view is that the soft product, for want of a better word, the people, the cabin crew, the food, the bedding, all that kind of stuff, it's actually pretty good. It's the seats and the aircraft that they're flying. Some of them are getting on for 30 odd years old with the long haul fleet. So it is very good news to see them modernising that. And I think you might be about to touch on this, but I'm going to steal your thunder anyway. The majority of these are also going to be fitted with Rolls-Royce engines, which the United States have exempted from tariffs as well.
Hence why Rolls-Royce again is in the top 10 performers so far this year on the FTSE 100.
We did see them take a big lurch lower, didn't we, when the tariffs were first announced? But now that risk has been removed, it's sort of full steam ahead for them again.
Yeah, absolutely. And 32 787-10 Dreamliners from Boeing at $397 a piece, 21 Airbus A330-900 Neos at $374 million a piece, subject to shareholder approval in June. But ultimately, I think that's welcome. It shows that they have confidence in their ability to be able to fund these upgrades and have options to purchase further 10 787s and 13 Airbuses. Rolls-Royce engines, all good, really. I think certainly in terms of looking at the share price of these very big British marque brands.
Absolutely, fully agree.
Pubs, your favourite topic.
Are we going now?
JD Weatherspoon.
5 o'clock somewhere.
They posted a decent set of numbers as well. Looking at the shares there, seen a nice pop higher in the share price in the wake of their third quarter numbers. Like-for-like sales up 5.6%. On a year-to-date basis, 5.1%. And Tim Martin saying the company is going to continue investing in improving its pubs. So he's obviously fairly upbeat about upgrading the pubs, investing in the pubs. Obviously, on a purely locational basis, he's still selling off ones that essentially aren't doing particularly well, but the ones that are, they're investing quite a bit of money in, and plan to open 4 to 5 new pubs this year and another 10 next year.
Yeah, and again, you speak about sort of votes of confidence. I think that's a pretty, significant vote of confidence in how JD Weatherspoons at least see the UK economy doing over the next sort of year or so. As you say, they wouldn't be looking to continue expanding in a sector that is, let's be honest, struggling on the whole. They wouldn't be looking to continue investing if they were concerned. They'd be looking to batten down the hatches to try and deal with things. So yeah, very very positive update from them.
Indeed, which sort of flies in the face of our pessimism about the UK economy, doesn't it, really?
Well, it does, doesn't it, really? But
something
who's going to be
align.
right, the two Mikes or Tim Martin? Time will tell, I guess.
Yeah, time will absolutely tell. And moving on to Disney, again, decent numbers. We talked about whether or not the numbers would herald a rebound back above $100 to 110, and it's exactly where we are. Big jump on the day of the numbers are released back on the 7th of May, and we're now back towards the highs that we saw at the beginning of March. And again, it's the parks division that helped, sales rising 6%. So again, streaming business turned a profit, again, fairly positive. But for me, I think the big test will come with the highs this year, and the highs in November, December, around about $120. If we can get back through there, then perhaps Disney can start to think about the levels that we saw back in 2022, 2023, when they were around about $180. But at the moment, they're still fairly low relative to where they were 2 or 3 years ago.
Yeah, absolutely. And as you said, it was that parks division that really drove it. And of course, that comes ahead of what is the critical quarter for parks. But again, they seem pretty optimistic on that front. And correct me if I'm wrong, but I believe they're going to be opening up their first new park in a number of years, and their first park in the Middle East, in Abu Dhabi as well. So clearly looking to continue expanding on that front.
That'll be interesting to see how that plays out.
Yes, apparently
I'm going to skip over DoorDash and Uber. Nothing much to see there. Again, both of those fairly decent results.
DoorDash have gone slightly insane on the acquisition front, though.
They have, haven't they? Yeah, I mean, obviously not only Deliveroo, but they also, which they paid $3.86 billion for, but $1.2 billion for 7 Rooms, which is a New York-based tech company along the lines of Open Table. So you basically book
restaurant reservations,
restaurants, via a third party website. So it'll be interesting to see whether all that additional acquisition cost actually offers shareholder value. Historically, it doesn't tend to do that, but we'll see.
Yes, indeed.
This week, a couple of things that I've picked out. Burberry, they were a horrible set of results, I've got to say.
Oh, I thought you were going to say horrible clothes, but either works.
Well, both. But the market appeared to like what Mr. Schulman had to say, the relatively new CEO, 20% of his workforce.
Yes, I must admit, I always find market reactions like that a little bit awkward. I mean, they're completely understandable from a purely financial perspective. You are cutting workers, you're lowering your overheads, hopefully trying to increase profitability. The market reaction makes sense. It's just never, ever nice to see a stock go on an absolute tear when you know that there are a whole hundreds, if not thousands, of workers who are going to be made redundant on the back of that. It's never a particularly nice thing to see.
No, it's not. I mean, we've all been there. I mean, I've been in all my time in the city. I've probably been let go 2 or 3 times that I can remember in my 30-year career, and none of those occasions have been particularly pleasant experiences.
No.
But it's something that unfortunately, it's part of life, and you just have to bounce back from it. Sometimes, it's not as easy to do as perhaps people think that it is. But the numbers themselves, a full-year operating loss of £3 million. They're going to cut 20% of its staff in response to a sharp decline in sales and revenue of 15%. Total revenue in 2025 fell to £2.46 billion from almost £3 billion the previous year. So that's quite a sizable drop. But the problems in the luxury sector aren't unique to Burberry.
Yeah.
LVMH has been struggling. Hermes have been struggling. Not to the same extent, I might add, but they've been struggling over the course of the past 2 or 3 years. Same-store sales across all the regions. Asia Pacific, 16% decline, 1/6. America saw a 9% decline. We've seen a modest recovery in the share price, but we're still well below the levels we were at the start of this year or in February when they were well above £12. For me, I just think that, I don't know, I just don't like the Burberry brand.
No, and I mean, I will preface this by saying I'm not entirely sure either you or I are right in the middle of their target market. Let's
No.
put it that way. But I
No.
must agree with you on that one. I do just wonder, though, are they an acquisition target? Is there value in anyone snapping them up? As you say, that the issues are not isolated to them. It is something that the luxury sector more broadly just seems to be undergoing this huge slump and or reset at the same time. Is it ripe for a bit of consolidation, perhaps?
Well, in April 2023, the Burberry share price was £26.
When they were in the FTSE, of course.
Yeah, they are now below £10.
Which
So
speaks volumes,
there's an
doesn't it?
awful lot of value come
Yeah.
off that. So maybe they are an acquisition target, certainly I think. But the big question is, why would you want to buy them?
Well, this is the thing, if
What
maybe
value does the brand has a value, but what do they have in their locker that makes them a target for the likes of LVMH, Hermes,
yeah,
or any other luxury brand for that matter? I mean, Hugo Boss is struggling, and I think Sports Direct have got a stake in them as well. So
that's a mark of
maybe
luxury,
Mike
isn't it?
Ashley could be going after Burberry.
That would just fit all the stereotypes of the people who dress in Burberry clobber, wouldn't it, if they ended up being owned by Mike Ashley?
Yeah, I'm not going to go there.
No, we probably shouldn't. We should move on.
ITV, full-year numbers in March, 3% decline in full-year revenue. ITV Studios, 6% decline, but that was because of the US writers' strikes. The Q1 update, 15% improvement in digital advertising revenue, still a 3% decline in overall media and entertainment. And on guidance in that particular area, they're expecting further weakness with a 14% decline in Q2, though the comparatives are compared to last year when the Euros was on, which saw a big uplift in that particular area. So I don't think we can really glean too much from that. ITV Studios guidance left unchanged, total group revenue up 4%. It's doing okay. It's not blowing the doors off. The bigger question is there potential for further share price gains? I think I talked about this in my Substack. It's been trading in a range between sort of 65 and 85p over the course of the past 2 to 3 months, and it doesn't look as if it's going to change out of that range based on these set of numbers.
I was going to say, certainly a very, well, I guess mediocre set of results is not going to change that story very much, is it? Really,
No.
as you say, it's kind of one of those slates you sort of look and you go, well, okay, there's nothing I can really complain about, but also there's nothing where you really say that's brilliant or that's a real catalyst for further upside. It's very much a sort of, well, thanks for releasing that, but as you were sort of situation.
And there hasn't been that much more chatter about ITV Studios being spun off as a standalone business. I mean, I've never understood the logic behind.
Why would you do that?
Why would you do that? Yeah. I mean, what you're then left with is the advertising business, ITVX, and pretty much everything else. Why would you do that?
Yeah, so you end up stuck with a very cyclical business in advertising and a ITVX, which is operating in streaming, and which is a massively competitive sector anyway. At least with the studios business, you've got a tiny modicum of diversification in your revenue streams.
Well, you've got a huge amount because they deliver programs for Amazon Prime, Netflix, the BBC. They're a content provider in their own right. So you might as well keep them within, the wrapper that is ITV. You've got advertising here, you've got digital entertainment here, and you've got the studios, you've got the production arm here.
Yeah.
It'd be like splitting up the BBC.
Yeah, it doesn't make a lot of sense.
That may not be such a bad thing.
Well, yeah, I was going to say maybe not the best analogy.
That's me, Ken, from any of future BBC programmes from here on in.
You're on a blacklist now.
I'm going to finish off the look back with Walmart. Like Amazon, you can't get much bigger than Amazon and Walmart when it comes to the US retail market. And ultimately, it painted a fairly resilient picture. They were cautious about their guidance, tariffs being the key concern, as with Amazon. But ultimately, they still expect to see net sales increase by 3 to 4.5%. They're not really painting a picture of doom and gloom. And I don't think many companies are. They're just cautious.
Yeah, and I think you're absolutely right. It is caution as opposed to pessimism. I guess is probably the best way to frame a lot of the guidance. It's very much a case of we're not sure what's going to happen, so we'll rein in our expectations a little bit, as opposed to, forecasting some sort of impending doom. And I think we've actually seen quite a notable change in the tone of guidance as earnings season has progressed. I mean, you think back to the start of earnings season, which was pretty much as Trump was pausing the Liberation Day tariffs, and if a trade embargo went into place with China, and you had companies like the airlines actually issuing two sets of guidance, basically saying, here's a base case scenario and here's a worst case scenario. But as you say, Walmart, the biggest retailer in the United States, certainly not sounding the alarm just yet, although they were laying the groundwork for price increases. They were saying that even at these lower tariff levels, it's not something that they can entirely absorb. So again, from a sort of macro perspective, we're still looking at higher prices. We are still looking at inflation in the States starting to move higher. Even if tariffs aren't passed on in full, it does seem that, and I would argue, if Walmart can't absorb the full cost, then probably nobody can.
Well, I think that will probably help explain the Federal Reserve's caution when it comes to cutting rates.
Absolutely, and they are right to be cautious on that front. I think this sort of wait and see approach that the Fed are taking is very much the right one.
Whereas the Bank of England, obviously, I think could perhaps be slightly more, I don't know, dovish in their guidance, perhaps. Because we haven't implemented tariffs here in the UK. I think that's one of the good things that the current government did. It didn't knee-jerk react, and ultimately has managed to get a form of agreement in place that insulates an awful lot of its really big companies from the fallout of this particular tariff war.
Yeah, no, you're absolutely right, and this is a conversation I was having yesterday, actually, this seminar I went to, which is why we're recording today, along the lines of the impact of tariffs and the policy response of tariffs is very different when you look at the US versus the rest of the world, because the US has a potential inflation issue to deal with, whereas actually tariffs in the rest of the world are likely initially to prove disinflationary. So the policy response for other G10 central banks is easy. You just cut rates and sound dovish. The policy response of the Fed is a lot harder because you've got to juggle contrasting risks to both sides of the dual mandate, where those objectives could ultimately begin moving in opposite directions. For Powell and his colleagues, that's a hard enough job as it is. And then when you've got a very shouty, angry man down the road in the White House telling you you're not doing the job very well and he wants rates to be lowered, it makes things even harder.
Indeed. Okay, so that's basically looking back, talking about tariffs, obviously, in the US retail market. We've got Target and Home Depot due out next week.
Yes.
So I think we'll go straight to that, even though it's at the end of my list, because it's topical. Why segue back to it when we can segue straight into it? Target, I mean, Walmart's been doing very, very well. Target, not so much. I was just looking at their share price, and it's pretty much gone one way in the last 12 months. It's halved. They've struggled in a way that Walmart have not. And it'll be very interesting to see what Target has to say about the US retail market and whether or not there is, well, what's the word I'm looking for? Not cautious. Yeah, cautious. Seeing if they're as cautious as Walmart are. Obviously, I think there's an awful lot more downside priced in to their share price than, say, for example, Walmart. But I don't think they're helped by their sales mix. We've got food sales are a much lower percentage of its footprint compared to Walmart. So you're not really comparing like for like. 23% for Target compared to 60% for Walmart. It sort of rather begs the question, why don't Target do an S, Marks and Spencer, and try and make it a more of a 50-50 split? Perhaps they're missing a trick. They're also not in the same locations. And one of the things that I took away from Target's recent numbers is they've blamed something called shrinkage for an awful lot of their problems, which essentially to you and me is shoplifting.
All right. Why can't we just call a spade these days and say people are nicking stuff off our shelves? I'm not sure there's a lot I can add to that, mate. That was incredibly comprehensive. But I think, just again, it's going to be that broader, from Target and Home Depot, the broader commentary on the state of the consumer, albeit with the caveat that both are considerably more weighted towards discretionary spend than Walmart, who we obviously have already heard from. But again, I think the other thing to focus on is what do either say about tariffs? How much of the cost increase are they planning to pass on to the consumer, and how much do they think they'll be able to weather themselves?
Well, Home Depot is an interesting one because it's essentially the US equivalent of B&Q.
Yeah.
Kingfisher, companies like that. And if you look at the share price of Home Depot and compare them to similar share prices here in the UK, it's chalk and cheese.
Yeah.
Home Depot, saw a bit of a sell-off between December and obviously the lows back in April. But the share price is up significantly from the lows that we saw back in 2020. I mean, it's more than doubled.
Yeah.
Why? The US consumer is more resilient than everyone else?
Well, I think there is an argument around that. I think there's a few things. The US consumer is, we always say, never bet against the US consumer. And we say it for a reason. It's not just us, chatting nonsense. You've also had...
That happens occasionally as well.
Yeah, lying occasionally. You've also had natural disasters, for want of a better word, hurricanes, people needing to rebuild, wildfires, of course, as well. That will have caused some demand, as sad as that situation is. And then I think you've also got the broader point, which is, generally speaking, US stocks have performed considerably better than their counterparts on this side of the Atlantic for some time now. So perhaps that divergence, although they are very similar companies, very similar sectors, very similar operating models, perhaps that divergence shouldn't actually be as surprising as we might think it is.
Yeah, I mean, annual revenue for 2024 was a record $159.5 billion for Home Depot, and they expect total sales to grow by 2.8% and for comparable sales to increase by 1% in 2025. So they're fairly upbeat about the outlook.
Yeah, absolutely. And we obviously need to see whether that holds now that the trade uncertainty has taken over.
Okay, so let's finish up with big UK earnings numbers. I mean, we've got CPI next week out of the UK, and we've got retail sales. We've talked about them. I don't think we really need to reinvent the wheel on that. We know that April inflation is perhaps going to edge higher again.
Yes.
It's 2.6% in March, I think, and it's come down for 3 months, it's slowed. I hate using the word come down. It hasn't come down, it's slowed.
Yes, absolutely. The pace of price increases has slowed compared to where it was. But yeah, I mean, I don't think we need to dwell on the UK economy.
What are we looking for next week? Do we know?
No, I was just scrabbling to find that as you were talking, and there's no forecasts that are out just yet. It's slightly too early. But I think that the general sort of trend of inflation is we are going to see prices. There's going to be a sort of hump in prices as we move through the second and third quarters, and then we'll begin to see inflation fade again as we move towards the back end of the year. You've got a base effect in there. You've got all of the, we know hundreds of prices went up at the start of April. Pretty much everyone knows that. So it's not going to be a surprise to see headline inflation move higher. I think the focus is going to be on those underlying metrics, and particularly services inflation. We know that is what the Bank of England are watching very, very closely indeed for signs of persistent price pressures. So I think that's really the metric to watch.
Okay, so we for UK CPI, we're at 3% at the start of the year. We're now at 2%. This is annualized. Core CPI is at 3.4. So it'll be interesting to see how much April CPI on an annualized basis goes up from the 2.6% we saw in March. Because I think that could influence how the rest of the year plays out when it comes to subsequent inflation prints. So if we get a weak number next week, we could suddenly see rate cuts start to get brought forward.
Yeah, and if we do get a weak number, again,
what is a weak number
on Threadneedle Street?
2.8, 2.9, anything below 3%?
Yeah, anything under 3, I would say, is probably a good result. And I know before anyone starts writing their letters of complaint, I know that is above the BOE's 2% target, but relative to where expectations are, it would be a good number. And again, it would just make you question what are the MPC actually seeing in the economy to make them stick resolutely to this hawkishness. But I don't want this to turn into another. We can't have two rants about the BOE in the same episode.
One thing I would say about the April numbers for CPI, lower fuel prices will help bring that number down.
Yes, that's true.
So, it's really a question of what the offset is. Lower fuel prices, higher council tax, higher utility bills, higher pretty much everything. So, as I say, if it's under 3%, that would suggest that we are probably going to get a quicker slowdown in the headline rate than perhaps the models are currently pricing.
Yeah, no, absolutely.
Okay, so digressing, we've got BT Group, Vodafone, Marks and Spencer's, EasyJet, and JD Sports.
Got 5 minutes to get through it all.
Okay, so listen, I'm going to skip over Vodafone and BT Group. BT Group has outperformed Vodafone on a share price basis quite significantly over the past 12 months. Vodafone needs to play catch up when it comes to convincing investors that it has a viable turnaround plan. New CEO Margarita Della Valle, she sold off the Spanish business, the Italian business is on its way, sold off the Swiss business. The share price has barely moved. BT Group, on the other hand, under new CEO Alison Kirby, share price has gone from strength to strength over the last 12 months. So for me, BT Group, hopefully the continuation of the turnaround plan will drive the share price higher towards 1p, 200p. What's Vodafone got to do? Because ultimately it's done nothing.
Yeah, and you almost get to a point where they've announced everything and they've spun off so many parts of the business. What is the market actually looking for at this stage?
Their biggest problem is the German business, Michael. It's still underperforming. It really does beg the question. Yeah, there was some one-off factors involved, but now they're going to focus on Germany and the UK. They really need to start making that investment pay, because at the moment the German business is dragging down the rest of the business.
Yeah, absolutely.
Right, Marks and Spencer's cyber attack.
What a lot of trouble there.
How much of that is going to be reflected in the full-year numbers that are announced? We've seen a bit of a sell-off from the peaks that we saw in April. But I would argue that it's been fairly contained. We've dropped from 410p to 345p. We're now around about 350p. If they can get on top of this, apart from the brand damage that it's done and the fact they've had to basically suspend online orders, I think there's a potential for perhaps that we could see a bit of a bounce back, as long as they can convince customers like myself, like yourself, that they've got this under control, and it won't happen again.
Yeah, no, I think you're absolutely right. I mean, I would say, I would imagine, as you say, if they can prove that they've got things under control in good order, then I would imagine the brand damage could be contained, because
or the monetary damage. How much does it cost them?
It's more a monetary damage thing at the moment, because I shop in M&S quite regularly, as I'm sure you do, and actually starting to notice more and more now empty shelves. And certain items are not being restocked. And I think that is actually the concern now for us. They've got a very, very strong brand. You would expect that shouldn't be damaged too significantly. It's the monetary impact of people going, well, actually, I can't get what I want, so I'm going to go and shop somewhere else. And I think that's the real issue that S have got to deal with now.
Yeah.
And of course, the fact that they've got no online business.
I think we need to see what the readjustment to the company's revenue outlook will be for the current quarter, as well as the profits outlook. The brand one is much less quantifiable.
Yeah, well, it's almost impossible to quantify it, isn't it?
Yeah, so I think the next two quarters are going to be very significant, I think, in the context of damage limitation for Marks and Spencer. So they're due out on the 20th. They've done a brilliant job in turning the brand around, not only in food, but also in merchandising. Yeah. Can they contain this and basically put the train back on the tracks again? EasyJet. We saw fairly good numbers from IAG, British Airways. The first half of the year is always a difficult one for this EasyJet.
Yeah.
It's a question of limiting the losses in the context of a strong second half. When they reported in January, the headline loss was one of £61 million. That was £65 million less than the same quarter last year, which was £126 million. So certainly they're making progress there. EasyJet Holidays expected again to see a further 25% customer growth. But that business is a very small part of the overall business. It's growing. It's growing very, very well.
It's still a small chunk in the grand scheme of things,
yeah,
isn't it?
It very much is so. So it's really just a question of how are they doing in terms of Q2 and what are forward bookings looking like for Q3 and Q4?
Yep, absolutely. And particularly those forward-looking metrics are going to be important because, as you say, it's a weird one where H1 is usually much, much poorer than the second half of the year. So it's a question of can they provide confidence that they are going to make up the lost ground that inevitably will be there in the last 6 months.
All right, so I think we've pretty much covered everything, Michael, and we've done it. Well, we've just gone over the hour, so I'm sure with some clever editing, Richard will somehow condense it back to underneath an hour. But
indeed.
Yeah, that's it for this week. Once again, thanks very much for an illuminating discussion, and I'm sure we'll find some interesting segues on TikTok later in the week or over the weekend on some of the topics that we've discussed. Anyway, so that's it for this week. Speak to you all again, same time, well, similar time next week, where we'll go through everything that we've discussed for forward a week ahead. So thanks very much for listening. Speak to you all next week.
Bye bye.
Cheers, Michael.